All right, welcome back, everybody. There's just a few of us here today. I like to see our diehard fans back in. So let's go over a little bit of what we talked about last time. Last week, we just kind of started the idea of how we were going to practically put to use a bunch of the concepts that we started talking about, how we might actually start choosing assets and what's going to fit into the right places. So we talked about lateral integration and how we might choose some securities for that, using the basis of sort of a balanced fund, sort of middle of the ground, really easy to work with idea. Things like cash and cash equivalents, super short-term bonds, things like that that are not aggressive, things that can be liquidated very quickly for little or no loss, really liquid cash assets. We moved into stage 2 where we started talking about longer term debts, index funds, some other fund securities like that, things that would suffer a little bit more loss if we liquidated them, but gave us a little bit of growth, potential for reinvesting dividends, interest, so we can have a little bit more longer term horizon with that. And we have a couple examples of things that we might use within that. In stage 3, we talked about how that's our most aggressive, growth-oriented piece of a balanced portfolio. This is where we're really looking to push for those long-term gains, let many, many years give us those average returns that we see in historical data. So this is where we're really looking for lots of time, lots of data that we can put together and have push us higher. That's our growth-oriented assets, stock funds, longer-term bonds, maybe a little bit, not too much of those, but sometimes if we're in, say, for example, we're in a high interest rate environment and we have those longer-term bonds, if rates start to fall, we can actually see a decent amount of capital appreciation from that. Junk bonds too, and speculative investments like individual stocks, new sectors, and that sort of thing. We got into the basics of vertical integration and how we would diversify, how really the first level takes care of any unsystematic risks for us, gets rid of those company risks, those country risks, sector risks, and stuff like that, and how as we move up, as our positions get smaller, they get more targeted, they do more specific things, and maybe just do some new strategies that we're looking to take advantage of. So with that first level, like I mentioned, we're just trying to participate in the overall market. We're just trying to feel that trend, see the same as the market performance, really low unsystematic risk, super diversified, lots of individual holdings within the funds, and low cost, hopefully, so that we're biasing our portfolio towards a lower cost overall. Even if we have some more expensive funds later on, we hope that these will just bring our averages down so we're not paying too much for general market trends. Level 2 in the midsection, we're just hoping to get some more targeted things. Maybe we're looking for some sector funds, maybe a little bit enhanced large cap, small cap, mid cap, things like that that are just a little bit more particular, but we're not paying huge fees in order to get these. Maybe higher yield bonds could sit in there, corporate, longer term. So if we're looking at stage 1 for our cash, we might think, okay, so we have our base that's with our super short-term government bonds, and maybe we'll get a short-term corporate bond fund in there or something like that. And then when we get to level 3 at the very top, that's where we're looking to take higher risk in terms of the actual section that we're in. So if we're talking about bonds, these might be slightly lower credit rating, not low, but just a little bit lower, or maybe it's actively managed and we think we can get something out of that. But that's where we're really going to look for that management experience to hopefully give us a little bit of extra. We want to set our base with just participating, paying low costs, getting what's out there in the market, and then we can sprinkle a little bit of this active management on there in the hopes that the tenured management experience that we see from the fund maybe can give us a little bit of extra, but if it doesn't, it's not really a drag to our overall portfolio. That's what we really want to prevent. We want to prevent a situation where we have so much active management and there just happens to be a really bad time frame for active management and it really drags us down, because that can happen. There are things that we don't expect in the market that can happen that can really pull down those active strategies. So this is where we keep those allocations really small, because like I said, if they fail or they don't go in the direction that we want them to, we want the overall impact to be really small. So we're talking about 2, 3, maybe 5% positions, really small, that just are not really giving us any extra risk. And then we took a look at this chart to just kind of give us an idea of what we should be expecting over the longer term, and how if you zoom into these shorter time frames, the investments that over the long term would give you the best returns can give you some of the most mediocre or downright negative returns in those shorter time periods. So it's just really reinforcing that idea of letting time do the work with growth assets. And then when we don't need that to happen, using stable assets so we're not at risk for those short time periods where the markets crash, like in 2008 or any of these other periods of time where there's been strongly negative returns. So today what we're going to do is we're going to start really implementing this lateral and vertical integration. And what we're going to do is we're actually going to start building a sample portfolio. So we're going to keep it really simple. We're not going to get complicated. We're just going to make this a really easy to understand, sort of do one thing for each section sort of idea. We're going to go through lateral integration, and then we're going to go through vertical integration. I'm going to show you basically how you can take these ideas that we've talked about and how that actually creates a portfolio. So again, we really want to remember visually how we're dealing with this. We're dealing with our cash needs first, and then we're dealing with a little bit of conservative growth, and then we're getting to more aggressive growth. And then we're diversifying, staying big, broad exposure. You can kind of think of this as how many different things would be included in this fund. When we get to the bottom, it's going to be a lot more stuff in there and bigger positions. And as we move up, it gets more targeted and the position gets smaller. So just remember that visually, and kind of how that ends up looking is when we go to each stage, we can think of it, each of it broken into these different sections. So really, this ends up being a visual representation of what the portfolio looks like if you're just not thinking about the individual funds, but this is how that's going to be represented. You're going to have that diversification in each stage. So we're going to start with a 3-fund portfolio. We're going to start super simple, one fund for each stage, and each one will correspond to a stage of lateral integration. And then we'll move forward and we'll start choosing other funds to put on top of them to further diversify and get those other things that we talk about. So we're going to start with a $100,000 balanced portfolio. The dollar amount doesn't really matter, but we're just going to say, this is our balanced portfolio. We're constructing a simple balanced portfolio from the ground up and using everything that we talked about. So it'll be roughly 60% equities, 40% bonds. I think when I ran the report, it really was closer to 55-45, but anywhere in that 50-50 to 60-40 range is kind of where I'm expecting to land with a balanced portfolio. And we're going to assume that this investor has some current cash needs. So there's some need to distribute, likely with required minimum distributions or some kind of easy to wrap your head around concept. But they also are expecting that long-term growth. So we kind of want the best of everything in this portfolio. And we want to make sure that, we're just seeing all of that in there. So we're going to start with these 3 funds. So we could be right here. And what we've got first is SGOV, and then we've got VBIAX and VOO. So what are these? Let's talk about each of these individually, and I'll sort of show you how they fit in there. So remember, stage 1 is short-term, cash needs. Stage 2 is sort of middle of the ground, a little bit of yield, a little bit of growth, kind of moderate, kind of you can think of like whatever the overall risk tolerance of the portfolio is, these are going to be the most aligned with that. Stage 1 is going to be lower, stage 3 is going to be higher, and then it's kind of all going to average out to the same. So what is SGOV? SGOV is a 0 to 3 month treasury bond ETF from iShares. And so you basically just got, what you have is this fund will go and buy treasury bonds that have 0 to 3 months left on their maturity. So they might have started as a 20-year bond, might have started as a 5-year bond, or might have started as a 1-year bond, but they buy the bonds that have 3 months or less left. So you don't have huge fluctuations when interest rates change, because the lifetime of the bond is so short that it doesn't really matter if you can go buy another bond for 0.5% more, because it's going to just expire anyway, and then you can go out into the market. So you have very little volatility, and you have very little what's called effective duration, which is pretty much if you took the interest that the bond is paying and the maturity left on the bond, and you kind of do some fancy math and put them together, it's always a little bit lower than the maturity, because the interest rate is sort of compensating you for that. So It's pretty inexpensive at 0.09 basis points. Remember, when we start at the bottom, we want those low cost funds. We don't want to be paying a lot for these. So this fund invests at least 90% of its assets, usually closer to 100, in US Treasury securities that have a remaining maturity of less than or equal to 3 months. So that's kind of effectively, it ends up being the same thing, because T-bills, basically they just start out with only a year and then it goes. So once you get sort of like, it doesn't matter how long the initial maturity of the bond was, they're just looking at whatever's in the marketplace right now, because it's all going to be effectively the same instrument. You're going to get the same interest rate because the prices fluctuate. Like, it's all going to be kind of the same thing. So they're just saying, we're not only going to buy T-bills, we're just going to buy anything with 3 months left or less. And as long as it's a US Treasury security, yeah. So it will effectively be like you're buying T-bills, but even less maturity or duration because it's 3 months or less, yeah.
That once it matures, I mean,
So-
you have to go on right away and move it, or?
Right, so that's what they do. That's what this fund does. That's what the fund, so that's what they're handling. So they're buying and renewing like T-bills, but like they're handling all that. So it's like, this is why I had a client who they liked to just buy a T-bill over and over and over, and they were getting good yields, but I just told them, look, we can get the same thing, pay 9 basis points, you know, that out of almost 5% yield, and we don't have to do any work. And then you just let them take care of it. They've got way more than one, you know, treasury bill in there. The liquidity is higher. So it's like, you know, the benefit of doing this, in my opinion, is mostly the liquidity and the ease, because if you buy a single T-bill or you buy a single CD, you get the same sort of interest, you get the same sort of idea that your money's safe and okay, but the problem is you don't have the same amount of liquidity. It might be a little bit more difficult to get that money out or whatever the case may be, but if you're in an ETF like this, you sell it and the cash is in your account like within the minute, and then it settles the next day. So that's kind of the main reason that we look to these. So you see, so when you're looking at ETFs, the income is always going to be a dividend, right? So it's always going to be a dividend, even if it's made up of interest payments. So you will get taxed as interest payments, right? But because it's an ETF, it's like, it's the ETF's dividend. And it's just, what is that dividend comprised of? Yeah.
Probably a dumb question, but dividend, does that mean you're buying more of that SGOV?
So that
Or is it?
depends on the instruction in your brokerage account. So you actually get to decide whether it reinvests in the security or if it just pays to cash. So that's up to you as the holder. Yeah, so you get to choose that. So that's something that usually I like to, you know, pay my dividends to cash, and then I get to decide whatever I want to do with it, or I just do a rebalance and it takes care of it for me. But yeah, if you look at your brokerage account, you should be able to go to the individual security, and there should be an option to change the dividend instructions and or capital gain instructions if it's a mutual fund, and then they'll allow you to either pay it to cash or to reinvest. So the benefit of doing the dividend reinvesting, that is the only way that you can buy fractional shares of ETFs, because if it goes straight back in, they actually can buy you like 0.3 or 0.4 of a share rather than waiting to accrue enough cash to buy an entire share. So that can be kind of nice if you want to do that, but you can choose whichever way you want. So yes. So the standard deviation is going to be there because, you know, as an ETF, the price is going to fluctuate on a day-to-day basis. So we're looking at, yeah, so that's the standard fluctuation. So it's not over 3 years, but it's a 3-year look back. So it's a 1-year period over a 3-year look back. So we're using 3 years of data to average it out. And you're basically, what you're saying is, if you see the average return, which is, you know, something, it's kind of hard for me to, you know, squeeze that by compliance and say anything. But, you know, if you have an average return, let's say it's 3%, because historically that tends to be kind of, you might see 3.5 or 2.5. And usually it stays within that because the interest is the return. You're not seeing a fluctuation in price very much. And then every once in a while, you'll see that interest drop to like almost nothing. But the standard deviation is pretty much like, what is I think it's maybe 60% likely to happen. It's like that range, 60% likely that it's going to be up or down by 0.5%. Then if you go out another standard deviation, so that would be 1% fluctuation, that's more likely for it to be within that entire range. Then another one is like 95% prob. So anyway, that's statistics and all that kind of fun stuff. Yeah, so standard deviation, it's just kind of like, it's the band around the average return. So if you've got an average of 3%, and then you've got this band around it, that's where you can generally expect to be in a lot of cases, but not all of them.
It's a management issue also, because if you have a CD or a T-bill that matures, you don't see it on your statement or do anything. It goes over to cash, and you're like 1% or 0.5%. By the time you realize, oh, I should have bought a T-bill, it could be days or weeks later. And so this, you're automatically investing all the time. And it's just so much easier. We have clients that want us to buy individual T-bills. Then I got to make an appointment call, say the new T-bill's coming, and here's what I think the rate is. And then we try to edge them over here and say, well, we could go on this fund and be a lot easier.
Yeah.
In some cases, we wouldn't have any.
Now, another thing to mention is I just thought about this. Here's a reason you might buy a 0 to 3 month remaining maturity treasury bond ETF versus an individual T-bill. If you buy an individual T-bill, are you getting income? No, not until it matures, right? So a T-bill is what's called a zero coupon bond or an original issue discount bond. What that means is you have, usually bonds are sold at $1,000 of what's called par value. So that's the principal amount. That's what you get returned back to you after you make that loan. But a T-bill or a original issue discount bond, commercial paper, usually the stuff that's a year or less when it starts, they'll sell it to you at a discount. So they'll say, I'm going to sell this to you at $900. So you give me $900. Then when this matures, I give you your 1,000. So instead of actually paying you interest along the way for income, you just kind of, you get what's called phantom interest. So it's like you're getting income, but you don't actually get any of it in your account. And it's just saying, okay, we're accruing this value from the time that you bought until the time it matures. And the fun thing is you actually have to pay taxes on that income along the way, even though you don't get it in your bank account. Yeah.
Is it tax exempt from the state?
Yeah, so this will be tax exempt from the state because it's treasury bonds. Yeah, that passes through whatever investment vehicle you've got. 68%, okay. Yeah. Yeah, so that's a really solid amount of the time. And then that's also over the entire set of data. So you might have a year and go 70% of those days were within that, and then some of them were higher and lower. Anyway, so that's got a dividend yield. Last I checked, 4.9%-ish. So it went down a little bit for a while and it came back up. So that's interesting. So that's pretty good still. I'm still all about these, super short-term treasuries because the risk is so low and the yield is still high. Like if you just look at all the different sort of debt instruments and ETFs, corporate, and like everything that's high grade is kind of around the same yield. So I go, why take the extra risk of corporate debt and just buy these? Anyway, so that's stage one. That's kind of our cash equivalence. So if I wanted to, have a place where I could sell money from for my distribution, or if I wanted to park something to stabilize the portfolio and not feel tons of volatility, I might put some cash in here just for stability's sake. Next, in stage two, we're looking at Vanguard's Balance Index Fund. So this is an interesting index fund. It's like a dual index fund because it tracks two indices at the same time. It takes 60% of its assets and tracks a stock index, and then it takes 40% of its assets and it tracks a bond index. So you can see that in the description here. It costs even less than that SGOV fund, so 7 basis points, 0.07%. The standard deviation on this is considerably higher for 2 reasons. One, because we got a bunch of stocks in there now. So now that we got stocks in there, we're going to have stock market volatility. But the other thing that we're going to have, and you'll see this by effective duration being almost 6, we have much longer term bonds in there. So that introduces a little bit more volatility. over time because those longer maturity bonds, they're just more at risk because it takes longer for all that interest to get paid out and to be compensated for your locking in on those bonds. So you can see here that the dividend yield on this is considerably lower. And the reason for that is because, again, 60% of its assets are in a stock market index. And for the most part, yields on stocks are not very high. A high yield stock would be kind of like 3%, and growth stocks are 1% or less because they just sometimes don't even pay dividends at all. So you'll see a much lower dividend yield, but you're still getting some. And you'll see a higher duration because of the longer term bonds within the portfolio. But this combination tends to be, this fund is kind of like a representation of what the classic balanced portfolio looks like. 60% index stocks, 40% index bonds, and you just kind of get a little bit of everything. You get to feel all of the volatility all at once, but balanced in these two different places. So you'll see your standard deviations considerably higher than the previous, but not quite something like an S&P 500 or a growth fund, for example. Kind of like basically like 60 or 70% of that volatility because of the distribution of the assets inside of it. So moving on next, we will have the second most popular S&P 500 ETF ever, which is VOO, with an expense ratio of 0.03% or 3 basis points. And so this investment, I mean, I'm sure you can guess what we're doing here. We're tracking the S&P 500, which is basically the investment return of large cap stocks. Large cap stocks because it's the 500 biggest on the New York Stock Exchange. So we'll see a standard deviation here of a little bit higher than that balance fund, 15.45%. That can be sometimes a little bit higher. It can sometimes be a little bit lower. I saw it stretch. When we were in that crazy bull run for a while, I saw it stretched closer to 16, 17% at times. So standard deviation can change just based on the look back period. So if we're looking at 3 years, the standard deviation might be one number, but if we include another 2 years or another 7 years, that data could be a little bit different. And you'll see kind of reflecting of what I just spoke about for the last one, the dividend yield is even lower here because again, you're not getting a lot of, those, you're not getting a lot of yield from bonds because there's no bonds in here. So you're just getting yield from some value stocks. But because the S&P 500 has a lot of tech and growth stocks, those don't pay any dividends at all. So you're getting barely over 1%, just under 1 1/3% of dividend yield. But that's why we put that in that stage 3 for that long-term growth. Yes.
So, sorry, again, standard deviation means it could go up to 15.45%.
So standard deviation is, it's basically how far do we go from the average? So our average return might be 10% or 12%. It's the idea that we can go 15% away from it in either direction.
Okay.
So if we've got an average of 10 and a standard deviation of 15, it's likely that our returns are going to fall anywhere from -5 to +25. Like kind of within that band of range is where we expect to be about 70% of the time. It can be kind of confusing sometimes just because, you think standard deviation means volatility, so up or down 15%, but it's really from that average number. And for that look back period, whether it's 3 years or 5 years or 10 years, that average could be different as well. So it could be like shorter term, that average return could look like 30% if you've just been in a crazy bull run, but you might stretch over the last 10 and it gets closer to 12 or 10. So it's all of this is completely relative to the data that we're looking at and what period of time we're looking back on. Yes, sure.
When do you actually see what you're getting charged when you
No,
sell?
you will not ever see the expense ratio because it's charged internally. So it just, especially with something like this, the one way you might be able to tell is if you looked at, I don't know, you calculated all the dividends of the stocks. You saw, ooh, there's a little discrepancy, but you'll never see a line item for it anywhere. You won't see it in your investment account. You'd have to dig into the financials of the actual fund company because it's kind of like, it's kind of like if you buy a stock and they spend money on something internally, you're not going to see that in your brokerage account because it's inside of that company. You're just holding a share that represents total ownership. So same thing with the ETFs. That's all internal cost, but they do have to represent it because it is technically coming out of your returns.
So trying to buy assets or
Yes, exactly.
you don't get part of that.
Right. Yeah, so it's kind of different for mutual funds and ETFs because for mutual funds, you're actually putting your money in the pot. So technically your dollars are getting charged that. But with an ETF, it's like it's their pot of money and your shares represent an ownership of it from the top down. You're not actually throwing money into the pool. So it's a little different for each of them, but it's effectively, yeah, the same concept there.
They're required to stay within a certain amount, they can't.
Well, I don't know if there's like an upper limit. I don't think so, but they just have to stay within whatever they said. So if they stated that they're going to charge this, they have to charge that or less. But there's not really, the main reason that these funds are inexpensive is because nobody's going to pay 3% for an S&P 500 fund. But back in the day when Bitcoin ETFs were nowhere and the only thing you could get was a Bitcoin futures ETF, they could just charge 2.5% because nobody else had a fund. I think it was Grayscale, right? Grayscale charged 2.5% to buy an ETF that just held long Bitcoin futures. And that was it. They didn't do anything else. They just held Bitcoin futures. But they were able to charge that because there was nobody else. Literally no one else had approved ETFs at the time. So there was no other way to do that in a standard brokerage account besides their product.
You have to put the range in the perspective, low and high. The goal is to be lower, of course.
Can I charge other fees, like administrative fees or anything like that?
It's usually inside of the expense ratio, but they're not allowed to charge anything that they don't fully disclose up front. Yeah.
Yeah, so that expense ratio will cover everything. So there's kind of two different types of expense ratio. There's gross expense ratio, which is all of the costs of the fund. And then there's net expense ratio, which usually is almost exactly the same. But sometimes there's, I don't understand how they work, but there's some sort of rebates that they can get that kind of pay them back for things.
They collateralize or put your money up for an option.
Okay.
Yeah. So
Yeah, so if they're like taking the stocks and then lending them out and getting interest, there's like some fancy stuff in there that they can actually make a little bit of money on the assets held, and then it reduces the expense ratio because they put it towards that. So, but net expense ratio.
Expense ratio. They can't do it for themselves. So if you own a bunch of Apple, they can lend some of it out to earn some rent on it, but they have to give it back to you by reducing the expense ratio.
Yeah, but net expense ratio is always the thing that you're basically going to get charged from your returns. And that's again why we like these super inexpensive funds for the base, because you're just not going to lose a lot to fees. And like we've said before, the number one detractor of returns is pretty much always fees, pretty much every time. Yeah, and taxes too. But at least when you pay the taxes, it's because you made money. The fees, you'll pay them if you made money or not. Your value goes down and they'll just take you further down. So here, theoretically, not saying you should do this, but theoretically, all the needs for the portfolio have been met. We have a cash position. We have a sort of moderate risk, little bit of yield position. We have a growth position. So all of those things are accounted for. Everything has something in place for it. So if you're DIY and hands off, again, like sort of, lower age, not doing a whole lot, or just really want super, super simplicity, you might be satisfied. You might be. But if you have more funds in there, you'll have more control. You'll just be able to do more things. So as our own portfolio manager, we desire the freedom and mobility to rearrange our allocations however we want, whether it's for planning changes or buying opportunities or whatever it is else that we want to do. So again, it's sort of like what are you trying to accomplish with this portfolio? Do you like to move around? Because if you've got a taxable account and all you've got is these three funds, and you go, wow, S&P sure is up a lot, and I want to go buy, value funds, or I want to go buy some other sector, and now you got to start thinking about, oh man, those capital gains are really high on this, and I don't want to take from my cash. But if you have a more diversified portfolio, there might be sectors that are down a little bit more, and you're willing to, maybe you don't need to pay taxes on that, and you have a rotation. There's just more things that you can do if you have more diversification through positions, more tax efficient things. But in terms of return potential and standard deviation and the super basic stuff, I mean, we've basically made a good portfolio here for this sample need. But let's go on to the next layer because we want to start adding a couple extra things. We want to start adding in some new things and see what else we can generate. So here we've got 3 more funds, SPSB, USMV, and VEU. So let's talk about what each of those are individually. First, we start with a ETF from SPDR, which is a short-term corporate bond ETF. This one is, again, really inexpensive, 0.04. Investment seeks to provide results that, before fees and expenses, correspond generally to the price and yield performance of the Bloomberg US 1 to 3 year corporate bond index. Now, remember, we're still in stage 1, which is why we see this effective duration number low. We don't want this to get very high. Generally, for portfolios, I don't want to see the number go above 3, period, just because, you know, it depends on the interest rate market, but that just introduces some extra risk. But we're still keeping that number below 2 years. Our dividend yield is still nice. It's still above 4.5. We're doing really well. And you can see that the treasury bills are still paying more than the corporate debt, which is interesting. Our standard deviation is a little bit higher, but it's still relatively low in terms of all products that we can be choosing. But we start to get a little bit of diversification. So now we have both our treasury bonds and we also have a little bit of corporate debt. So we just have a little bit of different stuff. They might move differently at different times. It's possible that at certain times corporate debt could do a little bit worse than the treasuries, and the treasuries sort of hold us steady, or the other way around. But again, biasing towards low expense and low duration and just making sure that we're nice and diversified. We're not going into super risky high yield debt or individual corporate bonds. We're staying diversified. So again, solid dividends, low duration, relatively low standard deviation in the broad spectrum, and a really low cost. Next, we go to our second stage, and this is where we start introducing something like a this is iShares USA minimum volatility factor ETF. So this is, now we're getting into those passively managed funds. So you remember we talked about how we start with indexes, then passively managed with factor funds. So this is an example of that factor fund. So the idea is they created their own index to follow with this ETF that essentially tries to pick stocks that really just have lower volatility overall compared to a lot of other equities. So if you buy this, you're not going to expect the returns and volatility of a growth fund. You're probably going to feel something closer to a value fund, but maybe even more cherry-picked and possibly, you know, depending on the number. So you can see here, if we look at the standard deviation, this is a bit lower than something like an S&P fund or a growth fund. It's at 13.34, which is actually a lot closer to the balanced fund that we put below that. So that balance fund was somewhere, I think it was 12.8, and this is only a little bit higher, but this is all equities. So that's kind of interesting that they're able to pick these stocks that have a lower combined standard deviation, so you still get that long-term equity exposure, but you're not feeling, you know, that growth volatility or tech volatility that you normally would in something like S&P, growth funds, et cetera, et cetera. Dividend yield is still pretty low on this, and our expense ratio starts to climb a little bit higher, but you can see that it's still pretty low. 0.15% is still not even really something that, you know, is that much of a concern with long-term returns. 15 basis points, that's beautiful. I like anything that costs less than 20 basis points to me, spot on. No worries about it, I'm good there. I like cheaper, but I like to stay under 20 to 25 for on average. So
That they might still own old mutual funds that are managed. What kind of expense ratios are you seeing?
overall, for the older mutual funds, we're usually seeing somewhere between 40 to 80, anywhere in that range, from 40 to 80 basis points, so 0.4 to 0.8%. I mean, if you're really unlucky, you might be sitting in some of these really expensive, like a Holbrook fund or something that charges like 1.5% or maybe 2%, and then they carry debt and they push the interest payments onto you. So then you add in another 2%, and then it just ends up being ridiculous. But yeah, so that's kind of one of the reasons that we love ETFs, is because not every ETF is cheaper than every mutual fund, but they started to set the standard for inexpensive, broad-based index funds and all that sort of stuff. With ETFs, I could sell out right now and I could buy something else right now. I don't need to wait for the cash to settle. That just goes right across, because I know exactly what I sold this for and exactly what I bought this for.
That
So
leads to inventory of any funds you own and Google them and see what the expense ratio is. If it's not an exchange traded fund, then it's not an index fund. From the big providers, chances are you've got some high expense fund. Problem is, you can't just sell them and buy something else if it's outside of it. So that's the point.
It's easy to find the expense ratio.
Yeah, you could Google it.
Mhm.
I'm sure. Yeah, it's Google
Yeah.
is basically an AI.
yeah, you'll have a couple. I wouldn't trust the AI search function, but I would say that there's a couple different places you can find it. You'll have Google Finance, Yahoo Finance. Morningstar gives you like the basics for free. You don't actually need to have an account, and you can also sign up for Morningstar as well. And also the fund company will provide what's called a fund fact sheet. So if you just put the symbol fund fact sheet, you'll get all the data that they need to disclose, and that'll give you everything. And then obviously, if you really want to look, there's the prospectus, which is like, if you want to know everything about the fund and what it does, read that. But
Kind of like doing a Roth conversion, you pull money out of an IRA, go to Roth, you pay the tax. Here, if you've got a whole fund that overcharges a management fee, put a lot of gain. If you don't expect a dime leave to somebody else, then you see your account and start transitioning, selling a little bit each year just to get out of the high fee.
doesn't matter where you are. If you look on Morningstar, you can find the information. Google and Yahoo Finance usually will have that as well. But okay, so on the third stage of our second layer, we're now moving to VEU, which is Vanguard's FTSE All-World ex-US ETF. So this is pretty much exactly what it sounds like. It's your all-world stock fund, just excluding the US. So we're just looking for all of that other exposure. Now, if anybody had been holding this at the time of the last couple weeks, you would have noticed that it did just fine while the US stocks absolutely tumbled in comparison. So this investment seeks to track the performance of the FTSE All-World ex-US Index that measures the investment return of stocks and companies located in developed and emerging markets outside of the United States. So we're capturing both developed markets and emerging, so a lot of diversification. So if you don't really want to think too much about international, you could just pick something like this, and it just goes, okay, exclude the US, give me everything else. Well diversified, pretty decent. And one thing you'll notice is that these international stocks usually have higher dividends than US stocks. For whatever reason, they usually have lower valuations. So they pay higher dividends, so that's 3.07. And standard deviation is much closer to something like a US index fund at 16.78. Now, historically, US funds long-term, they beat the crap out of international stocks, just being honest. They just do so much better on the growth prospect. But the reason that I still include them in portfolios is because of exactly what we just saw. It's not about increasing long-term performance. It's about reducing short-term volatility. Because again, this is, if you remember, and we think back to diversifiable risks, or I guess either way, we just think back to the types of risks with the idea that US holdings fell by a lot and international didn't. What kind of risk did we feel there if we were all in US? Country risk. That was the risk of being all in one country. So if everything you had was in the US, all of your stocks fell. That's not necessarily the worst thing in the world, but if you care a lot about short-term volatility, and that's a risk that you are concerned about, it's worth considering how much of your portfolio you want in international. Because the whole reason for me for holding international companies is because when something happens specifically to the US and not really to anybody else, you get to buffer some of that risk by not having all of your assets drop at the same time. So that's always a reason to consider something like this. And again, low expense ratio. Just because we're moving up in layers doesn't necessarily mean we need to pay more. You can find a lot of really inexpensive products. But yeah, so that's why we like to include international holdings in our portfolios as well as US stocks, even if they don't always perform as great. So we've now added one more layer of diversification. So let's think about what some of the benefits might have been here. We got diversification in our short-term bonds by adding some of that corporate debt. So it's just a little something different. Maybe they'll end up paying more yields in the future. Maybe they'll go up in value. Who knows? But it's that diversification getting spread across the asset classes. We got additional equity exposure with less overall volatility than the broad market or the S&P index via our factor fund, via that minimal volatility fund. We have the potential for non-correlated returns with securities based outside of the US, which is what we just talked about. That non-correlated or less correlated, pretty much what that means is, do the returns follow the same pattern, or do they sometimes go in different directions, even if they go generally the same direction? If you shorten the time frame, like right now, if you look at max time frames, the direction that US and international equities go, it's both up. They're both going generally up, even if not as much. But if you shorten the time frame to year to date, you'll see where it splits direction. That's where we get that less correlated or non-correlated returns, so that means that even if generally the mountain charts go the same direction, maybe in the short term our volatility is actually less because they went in different directions, which averages those numbers smaller. So that's kind of the reason that we like these, or alternatives. That's why you hear about real estate and investment or gold. It's all sort of that buffering of the short-term volatility, not adding extra long-term returns. Okay, so now we're going to move on to the very last layer. We're going to add the last layer of funds to our portfolio and kind of see where we land there. And this is where we get to add a little bit of fun stuff, a little bit of different stuff. We're willing to pay a little bit higher prices for different things. So these are our next three funds: LDUR, JEPI, and TGRW. So if you take your pictures. All right. So starting off, we're looking at PIMCO's Enhanced Low Duration Active ETF. We're still in stage one, so we're still keeping duration low. It's still 1.54. We're still hoping that that standard deviation is low as well, 2.26. So this investment seeks total return consistent with preservation of capital, which is what we want for our stage one. So if you see things that are saying preservation of capital or prudent investment management or those sort of things, that's what we want for stage one, because they're maintaining low volatility, preserve the money that's in there. We're not trying to take risks to grow it, but we want to get our total return consistent with preservation of capital. So this is where we have one of those active managers trying to do something else to either buffer the low end or increase the top end. So the expense ratio on this is quite a bit higher than anything we've looked at so far. It's 0.50. But what I will say is that with bond funds, this is where you typically actually get to benefit from management experience. Because there's inefficiencies in the bond market, unlike the stock market, because they're traded in different ways and there's different types of risks that can be managed, total bond funds from good managers do really well in the long term. I know Fidelity has a total bond fund that's done awesome in the long term. I know PIMCO's got their own stuff, but this is really the main part of the market where the active management may actually benefit and historically has. So we still get a decent dividend yield. It's not quite as high as the rest. I'm not sure why. I haven't crawled through the holdings of this in a little bit, but the dividend yield is 4.08%. Duration is still low at 1.54, and standard deviation is still low at 2.26. So we're hoping that we don't see a whole lot of movement back and forth. We just want nice, stable income assets in stage one. So that completes our stage one. We have our short-term treasuries or short-term treasuries that don't move very much at all. We've got our corporate debt that moves a little bit more, and then we've got our actively managed low duration, which usually this will be a blend of both of those. So this will be, maybe they have a lot of treasuries right now, and maybe they have a little bit of corporate on top, but it's up to their discretion. So because we're making this the smallest position up on top, we're allowing them to have whatever discretion they want, and then they'll do the management for us. But because we've biased so strongly to the super cheap short-term treasuries, it's not that much of a concern for us if they do slightly worse than our index or competitors. So next, moving on to stage two, is JP Morgan's Equity Premium Income ETF. So this is one of those more complicated to understand, more fun ETFs. So this investment seeks current income while maintaining prospects for capital appreciation. And it does this by, one, creating an actively managed portfolio of equity securities, mostly of those in the S&P 500. And secondly, they will be using what are called equity-linked notes, selling call options with exposure to the S&P. So basically what they're doing is they're holding a decent amount of companies within the S&P 500, an actively managed portfolio, and then they're using derivatives. If you want to have that conversation, it's fun, but it's complicated. And they're generating extra income by capping the upside potential of the growth of those stocks. And they're generating income yield off of that. So if you have like a flat market, these tend to generate a lot of yield and not give up a ton of upside return, but they feel a significant amount of downside risk while having a capped upside risk. So it's a complex product. You have all of the downside risk. They don't do anything to protect that. So yeah, so it's because, you know, if they're selling those derivatives that say if the stock crosses here, I get rid of it, you're capping your upside return, but you also don't have any protection on the bottom. So if the stock market goes down, in fact, this fund has gone down pretty significantly. It didn't follow the stock market up very high, but it sure is following it on the downside. So it's one of those things where, you know, it's not going to give you a lot of protection, but it might give you some extra yield while still being able to participate in the stock market. So, well, see, that's the interesting thing about this is, yes, they're dividends. They're not going to get taxed like dividends. This is going to get taxed like ordinary income because it's premium income from selling derivatives. So because it's a short-term thing, it's not actually, some of it is dividends from the stocks, but not very much. So yeah, they're selling derivatives on top of the stocks that are inside here. That comprises a very large amount of the income. It's not very tax advantaged, but it does come off of securities that don't normally generate income. It's a pretty complex product.
It's pretty much like rent to own. Somebody rents the stocks and pays you a lot of rent. And if the market goes up, they'll buy them away from you from a predetermined price. But if the market falls, they're not gonna buy them from you, you own them. And yeah, but if you got 7%, that 7% money comes in, takes it off the bottom. So it's like if you had your house, you did a rent to own and the market stays flat, you're charging this premium for a rent to own privilege, you're loving it. But if the market falls, they don't buy your house, you still own it.
More active management on that. So what is the benefit of this? Well, one is you get higher yields while still having blue chip stocks in the portfolio. So it's kind of like you want yield like you have a bond, but you want stock exposure like you're owning an index. And you blend the two by giving up some of that long-term growth prospects. So this is again why you kind of place it in the middle there, where it's like, yeah, you're going to feel some downside, but it's going to shoot off a lot of dividends. And if you wanted to, you can take dividends from something like this and buy the underlying index. So if you're at a flat market and it's shooting off a ton of yield, you can buy more S&P. And so it's kind of, it's a more tactical thing, and it's a much more complex thing to put in your portfolio, which is, again, when I say all of this is purely educational, and this isn't a specific recommendation. I just like to show this off as an example of that top level, actively managed, more expensive, sort of complex product that is an example of what's out there. It may not fit your needs at all.
You don't give up all the gain. The buyer might have to wait until it goes up 5 or 10% before they can buy it away.
We can really dive into the idea of this strategy a little bit later. But anyway, let's move on to the next. So okay, let me go through the. So we've got an expense ratio of 0.35, which isn't ridiculously expensive, but it's definitely more than what I'd typically look for in a fund. We've got a standard deviation of 10.55. So you notice that standard deviation is squished down in comparison to the S&P. So that'll be 1 because of the dividend yield, so that when the returns are lower, all this yield is sort of kind of bringing us back up a little bit. So if we go down by 10%, but I still got paid out 7% in yield, that didn't feel like that much of a decline to me because I got all that income. And if you have that capped upside, the swing up is not that drastic either. So both of the returns are sort of squished towards the middle because of that. and then your dividend yield is close to 7%.
So you got needs fund, and when I was looking at funds, it wasn't down nearly as much as the overall S&P.
Yeah.
And it's kind of like if you own real estate, if the market gets real questionable, your rental that's got a long-term lease is gonna hold its value than an empty house that hasn't been rented yet. So this is not gonna make as much on the upside, but I'm happy to see that it wasn't down nearly as much.
Yeah. So moving on to so that basically concludes our stage 2. Remember, that's sort of our moderate volatility, nice yield, kind of in the middle. And now we're moving on to the end of stage 3. So this is T. Rowe Price's growth stock ETF. So this is a managed growth fund. This investment seeks to provide long-term capital growth, usually investing in stocks of large capitalization with strong cash flow, above average rate of earnings growth, the ability to sustain earnings momentum during economic downturns. So a lot of quantitative and qualitative analysis. You can think of this as like, that's that guy who's just sitting down looking at financial statements from stock companies and going, that matches my thing, that matches my thing, I'm buying these 4 stocks or whatever it is. So there's a lot of specific analysis that goes into this, and you can see that this has a dividend yield of precisely 0 because they're growth stocks. We're not looking for income producing securities, we're looking for stocks that are going to grow. So the standard deviation on this is a lot higher than some of the other things. You can see the standard deviation is 21.45. That's a really, really wide channel that returns can be in. So if you're looking at something like the S&P that has a standard deviation of 16 or 17, this has 21.5. You might be hard pressed to look at that and go, okay, the standard deviation is really high, the expense ratio is really high, that better have some crazy good returns for me. But you might look at the charts and you might see what they're doing really sits well with you. I don't know. But the expense ratio of a fund like this, again, 0.52%. So creeping up in that higher expense managed territory. And I can see some stinky faces out there like, I don't like paying all that money, and I'm with you. When you can just buy an S&P 500 fund for 0.03 versus 0.52, hard pressed to find growth funds like this that actually pay you for your time. So, nope, I'm bringing it up simply as an example. Yeah, none of these are what I would recommend you use. They're just, I want to show them so that you see the information about them and you can understand how they fit into each spot. So like this is simply a representation of a managed fund with stage 3 risk. Right. So you may want this, you may not. You may want something else. You might not even want managed funds in your stage 3, but it's just, I want to show you examples of what's out there so you sort of understand how to categorize each product. Then go, okay, I understand where that fits and where I might put it. So that if you look at your own portfolio and go, oh, this is supposed to be in that stage and that level, and that doesn't make any sense, or I have so much high cost, or I have too many managed growth, help you sort of understand what each position represents.
You can look at the mountain chart, and if the fund is far above its index, then we don't worry about the expense.
Yeah.
If they're doing something that we don't have time, can't do, or whatnot. But if they're not outperforming the category and index, why are we paying this?
Exactly. As we move on, we've now completed our sample portfolio construction. So really, really keep in mind, it's a simple sample. If your needs are more complex or your assets are much larger than this, you should probably add additional levels of diversification and maybe even more stages of lateral integration. Who's to say 3 is exactly the right number for you? Maybe you like saying 1 year, 2 year, 3 year, and you just like breaking it up like that. If that works for you, that's great. It's really more about understanding how to fit different types of asset classes into what you want to accomplish and how long you have to accomplish it. So this allocation is based on a balanced investor. You might be more, you might be less. This is that middle of the road, maybe, sort of early stage retiree or something like that. These securities are not specific recommendations, but rather generic examples of possible choices. So your goal with everything that we talked about is to use the information that we present to help understand the characteristics of the different products that are out there that you might have and how to evaluate them. And trust me, you will get a lot more tools as we go on, more complicated and, just really specific ways to evaluate these different things. Again, just remember what that pyramid represents. We're aiming to bias towards those low-cost, broad investments, and we're aiming to have smaller positions in the managed, high-expense, hyper-specific, those types of things. So the more specific or less diversified and more expensive a position is, the smaller we want it to be in our portfolio. Think individual stock or 2.5% expense ratio managed fund versus S&P Vanguard fund that costs 3 basis points. Or you might be at Fidelity and they have quite literally no expense ratio funds for you to hold. So it's like bias towards those, sprinkle in these. So again, these are going to be just total ballpark numbers. They're like a lot of this just had to do with me putting in positions and tweaking it around and making it fit. But if you just want somewhere to start and vaguely kind of look around what you got, you can start here. So this will be the stage percentages. I will say those are going to be the most changeable, because that would be like, do I really want 40% of my portfolio in cash and cash equivalents, or do I want 10% if I just don't really have a cash need? It's more, I would more base the percentages for the stages on like how many years you want to serve for each sort of need. Like if you say, I'm going to buy this thing in 1 year, but then once I do that, I'm not going to pull any money out of this portfolio and it's for my kids now. You might not have such a big stage 1 allocation. You might have it be maybe a year plus 10% of the portfolio. It's really more needs based. But if you just, this is really for that balanced portfolio. So if you follow this, you'll mostly land in a balanced portfolio, sort of that 60-40 range or 50-50 or 40-60. Yeah.
For a guy that's close to 70, 40%. Good percentage every year. Should I be more cash?
So again, just based on age, I would say, yeah, this is probably relatively good. But again, I would be looking at what exactly are we trying to do, which is why all the planning comes into play and why I can't really make a recommendation or even like too strong of a suggestion. So it's just like, if I know that, assets are going to go here or this is going to get left here. But let's just assume, for example, almost 70 person, this is their income for their lifetime. Maybe they want to leave a little bit at the end. Yeah, this is pretty much where you'd be at for that middle ground, little bit of growth to leave at the end, but maintain assets for me to take over time. This is probably going to be there. But this is where I would really be using like the idea of looking at your expenses, forward thinking, and think, okay, how am I going to sustain this? And then sort of think, okay, I would usually plug in between 1 to 3 years in just, if distributions are happening, in nearly cash. So it's just like, no matter what happens out there, I've got money to pull from just all the time. So that's kind of like the main thing that I'm thinking about. And then the layers, decent, like most of it in layer 3. You can put more or less in layer 2, but since I tend to bias towards low cost anyway, they're not going to be like 30, 40, 50 basis point expense ratios. But then we get to that top layer. Actually, they should be switched around. Layer 1 at the bottom, you get it. But smallest high cost, hyper specific allocations at the top, lowest cost broad base allocations at the bottom. So if we're looking at a $100,000 balanced portfolio and we take those percentages and we split them out here, we're going to start seeing $18,000 allocations in stage 1 and 2 for the base, 16 layer up, 6,000 layer up, and the math just shakes out percentage-wise in terms of those portfolios. So if we move forward and we look at the securities that we chose earlier, it's going to be this list right here. So this is kind of what we're looking at. So if we have $100,000 and we split it across all of these securities right here, what could we do to improve the portfolio? Well, we could further diversify the income holdings if we wanted to. We could have some more longer term government bonds in there. We could include high yield corporate bonds if we really wanted to. If it's a taxable account, we might be considering municipal bonds for tax-free income. And maybe we add more sector specific funds. Non-correlated investments. Maybe we want some cyclical sector funds, utilities, real estate, all sorts of different things. Maybe we want some more defensive holdings, just really getting more different stuff within the portfolio, getting nicely diversified, being spread out across the different asset classes, really making sure that we have all these different things that we could pick from and move around in if we need to. So a couple things to remember. Each portfolio will take a different form based on its purpose. There are things like model portfolios out there. I use model portfolios as a starting point myself because there's, a lot of data and analysis that goes into picking the securities in there. Oftentimes, though, you might have something that puts you just slightly outside of the model range. You can change some things, but each portfolio really it looks different based on what it's trying to do. So that's why it's not always the best option to just have an S&P 500 fund. Because if it's, like we talked about before, if that's your savings account for a purchase in a year, S&P 500 is not the important thing. If you're trying to grow your assets over time, treasury bills are probably not going to do it for you. A portfolio can be as simple or complex as you would like it to be. But regardless of how many funds you have, regardless of how many individual funds there are, make sure that the internal holdings are diversified. If you're holding one fund, don't have that one fund be a technology fund. Maybe have it be a balance fund or an index fund. If you're holding just 3 funds like we showed before, the reason that those 3 funds were okay in their spots is because that SGOV, tons of different treasury bonds in it, well diversified. That Vanguard Balance Fund, tons of different stocks and bonds in it, well diversified. The S&P 500 fund at the end, over about 500 companies with some extra ones for different share classes, but well diversified. All across the stock market gives you well diversified returns. Bias your holdings towards low cost. Fees can be a major detriment. Usually it's the first one. Usually the fees are the thing that take you down the most. So even with good performing funds, if you have a fund that outperforms by 0.5%, but they charge you a whole percent, you're gonna underperform by 0.5%. So you really have to weigh the pros and cons of those management fees and really what you're paying for. So remember all that when you're building your portfolio. Really just go for that low cost. If you just go over to Vanguard and say, set me up, you'll probably end up with a really low cost, maybe even less than this portfolio. Same thing at places like Fidelity, just making sure you don't get those expensive funds in your portfolio, but really important to bias towards that low cost. It will save you money in the long term, and that money will go straight back into your returns. So with that, for today, any questions?